There's a tremendous opportunity for REITs to do joint ventures. They're integrated vertical operating companies. A lot of pension funds and a lot of pension fund investment managers like to invest in joint ventures with operating companies. But the advantage a REIT has is they have access to both private and public capital. So they have a tremendous advantage from a capitalist standpoint to be able to create arbitrage opportunities for investors who sometimes don't have those alternatives.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest today is Geoff Dohrmann, founder, chairman, and CEO at Institutional Real Estate Incorporated. IREI has been connecting professionals in the institutional investment and private wealth advisory communities since 1987. Geoff has an extensive record of involvement across the real estate investment landscape, and we're happy he can share that expertise with us today. Geoff, welcome to the podcast.
Nice to be here. Thank you for inviting me.
So, Geoff, as I alluded to in the intro, you've been in the institutional real estate business for close to 40 years. Is there anything about the current time that you find particularly interesting?
Yeah, I think, first, I've been in the business for 47 years, so a long time. I'm old. Investors, I think, today are really rethinking everything. They're really navigating kind of simultaneous dislocations. There's a pricing reset going on. There's capital market stress, and there's such structural demand shifts that are happening all at once. And I would say what's unusual isn't volatility. It's how long this period of uncertainty has lasted. Now, I argue that times are always uncertain, and what changes over time is that our perception or awareness of uncertainty accelerates at particular times. It's been accelerated or amplified, and it's been amplified for a very long time. So uncertainty has been a theme of investors over the last decade. And I'd say the investor's core problem right now is not knowing which signals really matter, because there's a lot of incoming right now, and a lot of confusion, a lot of change because of the introduction of AI and what it means. So it's an interesting moment because I think knowledge gaps are widening between those with context and those reacting tactically. And if I wanted to characterize capital, I'd say capital is cautious, but curiosity is starting to come back, which is a good thing.
Would you say that institutional investors are currently rethinking their real estate allocations in response to these broader trends that you've mentioned?
Oh, absolutely. First of all, a lot of the traditional model that people have used has been the traditional asset allocation model based on Markowitz's modern portfolio theory. So the theory is that you set a certain mix of assets that will develop along what they call an efficient frontier, which will be the optimal portfolio mix that will outperform depending on what's going on in the market. So if it's a bull market or a bear market, that kind of portfolio mix will tend to outperform. That's being abandoned right now in favor of a total portfolio approach, which was something that was really developed first in Europe and has come over and starting to gather traction here. And a lot of people are worried they're going to move away from real estate altogether because real estate really has not performed according to what people's expectations were. Part of the problem was that people's expectations were out of whack. They went through a double-decade period of outperformance, and the people just assumed that real estate was an outperformer. But the role that it really plays in the portfolio has really been to tampen down portfolio volatility. And that hasn't changed. So I think people are redefining the role that real estate is playing in the portfolio. So it's less about abandoning the asset class and more about re-underwriting old assumptions and returning to themes that resonated in the past. Investors still want the outcomes real estate provides: income, diversification, inflation protection. The frustration that investors are experiencing is that returns didn't arrive when expected and liquidity behaved differently from forecast. So people expected that their investments in open-ended funds, for example, would provide the liquidity that they were expecting, and they really didn't get what they thought they were going to get. So what we're seeing is pauses, extensions, reallocations, not exits. And so again, it's really a period of restructuring in the business right now. And the focus is shifting pretty much from how much real estate to what kind and structured in what way. So that's a different way of looking at the asset class than it has been in the past.
And that sort of leads to the next question about the difference between core and opportunistic real estate. What are the different risk valuation expectations between those two groups?
It really comes down to a return and volatility expectation. And core real estate return expectations have come down. They used to be 6 to 8. They're probably now 4 to 6. And opportunistic has always been 15 to 20% plus, and value added everything in between. But investors aren't really thinking about it that much that way, or some are, but a lot of investors are thinking in terms of core and non-core. And it comes down to what their risk tolerances are in terms of how much leverage they're willing to take on in the portfolio, which really separates the opportunistic from the value added, as well as how much development risk they're willing to take on. And I would say the real shift is less faith in clean style boxes and more attention to outcome after fees and leverage. So people are looking at things like distribution rates. Are they getting distributions that they anticipated? And what kind of outcomes are they getting? And are they fitting into what their expectations were for what they'd hoped to be able to produce in the portfolio? And as always, I think investors want fewer surprisers, not just higher returns. So investors can live with just about anything as long as it's not a surprise.
Great. And how would you say that your views and investor views have changed regarding REITs over the decades?
My views haven't changed much. Investors' views, I also don't think have changed much. The REIT industry as a whole, I think, has been somewhat frustrated that investors haven't embraced REITs over private investing. And if you look at the REIT profile, generally REITs tend to outperform private market real estate in bull markets and tend to underperform in bear markets. And that's because what you're getting is you're getting a lift in the REIT market from the public markets that you don't get from private market real estate. But the return drivers are the same for both. Both are investing in the real estate markets, and the long-term return pattern is driven by real estate fundamentals. What I like to say is a wrapper. And it's not which one is better. That's like asking which is better, a wrench or a screwdriver. It's a nonsense question. They're two different tools for two different purposes, right? And a wrench is wonderful for turning bolts, not so useful for turning screws. And a screwdriver is wonderful for turning screws and totally useless for turning bolts. And I would say the same thing for REITs. What are you asking the investment to do in the portfolio? That's what you have to ask. And if what you're looking is to tamp down volatility, REITs aren't a very good match because you get public market volatility. If you're looking for outperformance, REITs are a pretty good match. So it just depends. Both will deliver long-term real estate returns. The real estate returns that you get from private market real estate are going to look more like real estate in the short run. The returns that you're going to get from REITs is going to look more like small caps in the short run and more like real estate in the long run. So again, what are you trying to do in the portfolio and how does it fit? And I think most investors, most institutional investors, are exposed to both. They have significant REIT exposure through indexing because a lot of what they do is index. And they also, in many cases, have REIT stock managers that are running REIT stock portfolios. So it's not like they're not investing in REITs, but they're investing in private market real estate to accomplish a different thing, which is really to tampen down that portfolio volatility. Because to an institutional investor, volatility of performance is a cost. They are, particularly in defined benefit pension fund land, you're legally obligated to make up for any investment losses because you're obligated to pay out pension benefits no matter whether or not you have sufficient assets or income to cover it. So when you have excessive volatility, you have the risk of overfunding your long-term obligations. Because if you appear to be underfunded because of excess volatility, you're going to have to contribute more to the plan, but you can't get it back. So if all of a sudden you start to outperform, you've now overfunded and you can't claw it back. So that's a cost. And what most pension fund investment managers are attempting to do, or staff at large defined benefit pension funds are trying to do, is they're trying to fund their obligations at the lowest possible cost. And that's why private real estate really looks attractive to them, and why public real estate can play a role in the portfolio, but not one that will help them lower costs. So there are different tools for different purposes. And that's something I think members of the REIT market really need to take to heart and understand why investors are doing the things that they're doing, not just what they're doing.
Sounds like there's no sort of magic number that works in terms of allocations to on either side.
Well, again, allocation numbers are disappearing in favor of total portfolio approach, which says that every asset has to earn its place in the portfolio every month, every quarter. And you don't have a fixed allocation to anything. You're really looking at the investment characteristics of the underlying investment. And it's still, they have to play a particular role in the portfolio. but there's no fixed allocation anymore. That's going away. Now, that's not true for everybody. There's some people that still adhere to the old model of asset allocation based on Markowitz, but not everybody is following that trend today.
Interesting. You said that sort of concept started in Europe and came to the US. So would you say the Europeans have been ahead of the curve for some time on that?
Yeah, in many ways they are, and they have been. I think Europeans were probably investing at a greater rate in real estate long before US pension funds were doing that. And certainly on the public and pension fund side, public pension funds in Europe were investing in REITs decades before US pension funds were. So yeah, I think that's true. But the flip side of the coin is Europeans tend to be a lot more conservative in the way in which they use these investments. And so there is a divide between the way in which people fall out on the risk appetite curve. European investors tend to have the smallest risk appetites, US investors in the middle, and Asian investors a little bit higher.
And Jeff, IREI obviously hosts lots of different conferences. Are there any perceptions about REITs that you're hearing at these events?
I think most people understand the role that REITs play. The debates that often go on in REIT land about the role that these assets should play in a portfolio doesn't happen as much on the investor side. It's like the REIT market is trying to convince the investors that they're legitimate and a good alternative to private market real estate. And that's not an argument that needs to be made. The institutional investors are pretty sophisticated. They understand the characteristics of these investments very well. Most of the CIOs have CFAs. They've studied all of these investments at great depth. They understand what they can contribute. They're not naive. It's not like if they understood more about REITs, they'd invest more in REITs. They understand about REITs. They're not rejecting REITs. They're just playing a different role in the portfolio. And that's something, again, I think REITs managers need to understand. The senior management teams that lead these operating companies need to understand that it's not about a decision between private and public real estate ownership. It's about what role do these assets play in the portfolio, because that's the way that the institutional investor marketplace looks at them.
So, Jeff, are there particular opportunities that you see for REITs on the fundraising front right now?
There's a tremendous opportunity for REITs to do joint ventures. They're integrated vertical operating companies. A lot of pension funds and a lot of pension fund investment managers like to invest in joint ventures with operating companies. But the advantage a REIT has is they have access to both private and public capital. So they have a tremendous advantage from a capitalist standpoint to be able to create arbitrage opportunities for investors who sometimes don't have those alternatives. So I think there are REITs that have really understood this. I think Hamid Moghadam at Prologis understood it from the outset when he first took A&B Property Company public, long before he merged with Prologis. He understood that there was an opportunity to have a leg in both the private capital fundraising market and in the public fundraising market. And he understood that the window for public fundraising is not always open. And when it isn't open, the window often is still open for private fundraising. And it's also true that sometimes when private fundraising market windows are not open, the public markets are. So being able to straddle both of those markets gives you access to capital, and having access to capital allows you to grow your portfolio, and allowing you to grow to your portfolio enables you to create value for your shareholders. So all of that is something that I think people take to heart and think a little bit about. It ain't easy. It's different cultures, different people that need to be involved in raising money. When you go out and do a capital fundraise in the public markets, you hire a banker, you get your materials together, you form a roadshow, and in 30 days, you have your capital raised. It's 18 to 36 months to build a relationship that you can raise capital in the private markets. So it really requires a different mindset. But having both in your arsenal gives you significant competitive advantages. It's not an accident that Prologis is over $1 billion larger in market cap than the nearest public REIT. And that underneath that market capitalization is almost an identical amount of private capital that they're managing. So they're not just $1 billion, they're $2 billion larger than most of their closest competitors. And that's because they've been very careful about the way they've gone about straddling those two markets.
So, Jeff, last year's NAREIT celebrated 65 years of REITs. As you look ahead Do you see further evolution? I mean, do you think more sort of going along the path that, as you mentioned, Prologis has taken?
I think there's an opportunity for a lot more REITs to play in that arena. Again, particularly the largest institutional investors that can scale their capital, like joint ventures. And they are open to joint ventures with public companies. They like operating companies. Operating companies are close to the market. In many cases, they're vertically integrated. That means the information flows faster up through the organization. There are a lot of advantages you have to bring to the market. And it isn't just selling your shares. You can be doing joint ventures, and that's going to accrue to the benefit of all your shareholders. But when you're doing this, you also have to understand that your role is quite different. There's a difference between a fiduciary obligation to a shareholder and a fiduciary obligation to a pension fund. The fiduciary standards are higher, and the penalties for breach of fiduciary conduct are higher. So you need to understand that. A great place to go learn about that is learn about ERISA, the Employee Retirement Income Security Act of 1974, because those provisions really govern what you can and what you can't do. So you need to become knowledgeable about that part of the market, which you may not be knowledgeable about. And even though public pension funds, where the majority of the capital is flowing, are not subject to ERISA, they still adopt many of the ERISA principles in their governance provisions. So that's an important thing to be able to understand. You are a servant of capital when you're working in the pension fund market. And you need to understand that. It's not a privilege for them to be able to buy your shares and participate in your platform. It's a different mindset.
Given IREI's global vantage point, are there international public markets that look particularly attractive to you right now?
I think there's tremendous opportunity for reform in the European and the UK REIT markets. They don't have as much analyst coverage. The US market is a model for the rest of the world. There's a guy that, if you haven't interviewed, it'd be really interesting for you to interview, Peter Verwer, who used to head up the Property Council of Australia. He's been doing a lot of work in emerging markets, India, Malaysia, and China, about the evolution and development of the REIT markets there as well. And I think what's going to be the future. But they're immature as markets. Oftentimes, particularly in Asia, there's only a small amount of the company that really is floated in the public markets. A lot of times they're family-owned businesses, and their allegiances are divided between allegiances to shareholders and allegiance to family members and the family interests. So there's a lot of reform that needs to take place. But the more those markets reflect both their own internal cultures and the lessons that have been learned in the U.S. market and the evolution of this mature public securities market, I think the better off those will be. So I think there's tremendous opportunity for worldwide growth of the REIT structure, and particularly in really underdeveloped markets like Africa. You know, there's about, I think, 8 to 10 public companies in South Africa. And I'm not sure there are many outside of South Africa. Tremendous opportunity for growth. I just got off the phone earlier today with a gentleman from Nigeria. And in Nigeria, there's a real problem with trust because there's been a lot of swindling that's going on in the real estate market. And yet the need for housing is tremendous. It's a country of over 250 million people, growing faster than any other African nation. And it's growing much faster in their ability to supply housing. So the solution to it might be public markets, where you can really institute greater transparency, greater governance provisions to reinstate trust. But to my knowledge, not much has been done in that department yet. I think that's an opportunity.
This has been very helpful, Jeff. Thank you so much.
It's been an honor and a privilege to be invited to participate. I hope it's been helpful for your audience.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.